All right, here we go. We are in the last section of Chapter 7, Bonds. And we're going to go over bond ratings, and we're going to go over bond pricing, and we're going to go over interest rates. So let's look at bond ratings. What is a bond rating? Well, a bond rating indicates the ability of an issuer to pay interest or principal. How safe is this bond? Will you get your interest payment? Will you get your principal back? Okay? So there are companies out there that make a living doing this. And two of the largest companies that assign ratings are Moody's and Standard & Poor's. Yes, the S&P 500, S&P Standard & Poor's is a financial services company, and they do a lot of different things. One thing that they do is they maintain the S&P 500 index, and another thing they do is they issue ratings. They rate bonds, as does Moody's. Moody's rates bonds as well. All right, who pays for a bond rating? Well, it's a bit of a problem because issuers pay for a bond rating. So I want to issue a bond, so I pay someone to rate my bond, okay? Really, I think you'd rather have the buyers pay for bonds, ratings, but there's some issues involved with that. So issuers pay to have bonds rated. And not all bonds are rated because it's pretty expensive to have your bond rated. Therefore, smaller issues are not rated. Often they're not rated because it costs so much. All right, each rating company has its own rating code. You give a grade to the bond. How safe is the bond? And remember, the less safe the bond is, the higher the interest rate on that bond will be. Okay? And so each company that rates bonds has its own rating code or grading system. But typically they look pretty similar. AAA is the highest rating. There are not many companies out there with AAA ratings anymore. AA is the next. Most U.S. Treasury debt is rated AA, and it wasn't until 2009 prior to 2009, the U.S. government Treasury debt was AAA rated. But because we added so much debt back in 2009, the debt rating of U.S. Treasury debt went down to AA. It was a big deal. After AA, you have single A. After single A, you have triple B. Okay, and below triple B is considered to be more speculative. And that's important because many organizations have policies regarding their investments, and many organizations say that you cannot buy a bond that is rated triple B, below triple B, at the time of purchase. Okay, which leads to the next point, and that is ratings can change over time, both positively and negatively, based on the issuer's financial condition. So if you have a lower rated bond and things improve at your company, then your rating can be upgraded, and vice versa. Okay? Bonds that are rated D are in default, which means they've missed an interest payment. Okay? The lower the rating, as I mentioned, the higher the interest cost, and vice versa. So often, particularly in the private sector, when you have corporations issuing bonds, they will go to the rating agencies and they will argue the case for giving their company and their bonds a higher rating. That could save them millions in interest cost. Okay. So again, the relationship between risk and return. All right, so let's go to pricing. All right, although the stock market gets most of the press, the bond market in the United States actually has a market value that's about twice that of the stock market. The bond market is larger than the stock market. Okay? Its market value is approximately $30 trillion, which is about twice the value of the U.S. annual GDP. And this compares with about $15 trillion for the stock market. It's higher than that now. The stock market's probably worth probably 18, 19 trillion now. Okay? And 11 trillion, which is higher now, probably 13 trillion for, well, yeah, going on 13 trillion. You can Google some of these numbers, the annual GDP of the economy. Why is the bond market larger than the stock market? Well, first, the deficit's run by the federal government. Remember that I mentioned to you that in the equities market, the stock market, you only have private businesses or the private sector that issues equity. Okay, the government doesn't issue any equity. But you've got the federal government, federal agencies, state governments that issue bonds. So deficits run by the federal government cause the federal government to issue bonds. And then corporations typically will have many bond issues. I showed you way back in chapter 3, I showed you that Walmart had about 25 bond issues. Okay, pretty standard for companies to have 10, 15, 20 bond issues, but they may only do 2 or 3 stock issues over the entire life of their company. Okay, and that includes their private stock issues. Okay, all right. So how do we price? How do we read a quote on a treasury bond? Quotes on treasury bonds are different from quotes on corporate bonds. So let's make sure that we understand the difference. So here's what a standard quote looks like on a bond, a treasury bond. Okay? And so the coupon rate is the 9%. And then column 2, the month and year of maturity. So this bond will mature in November of 2018. That's when the principal gets repaid. Okay? Now you've got the bid and the ask. 2 prices, the bid and the ask. You didn't know this, but when you go to Yahoo Finance or when you look at the ticker tape in the Finance Lab and you see a price go across the screen, you see Walmart $90. Okay? That $90 is the last price. It is not the price. There are always 2 prices, a bid price and an ask price. The $90 is the last transaction that was done. All right, so what is the bid price? It is the price that an owner of a bond would receive if he or she were to sell the bond. So if you own the bond and you want to sell it, you'll get the bid. And the bid is lower than the ask. Okay? And this is for a bond, this is a percentage of par. Okay? So what does this mean right here? 133. Well, that's 133% or 1.33 times $1,000. So you multiply 1.33, which is 133% times 1,000, and you would get $1,330 for this bond. But what is this number here? Well, this is peculiar and unique to treasury bonds. You take the 27 and divide by 32. And you tack that on to the end of the 133. So let's look at it. So it's 133 plus 27 32nds. Well, 27 divided by 32 is equal to 0.84375. So you tack it on. You don't add it. You just tack it on right there. 0.83475. Okay? So it's 133 and 0.84375. So it's 1.3384,375 times 1,000, which means we're going to move this over 1, 2, and 3, and we get $1,338.44. Only for treasury bonds, and it was set up this way to keep the bid and ask very close to each other. You can see that there's only 1/32 that separates the bid and the ask. That is because the treasury market is very liquid, which means a lot of people buy and sell them, and there are a lot of bonds out there to be bought and sold. So this is a very liquid market, and the spread between the bid and ask is very, very thin. Okay? What is the ask price? It is the price someone would pay to purchase the bond. And the difference between the bid and the ask, that is the amount that the dealer would make. The dealer makes 1/32. Okay? All right, so if you own the bond and want to sell it, you'll get this. If you are a buyer of the bond, you don't own it, you would pay this. All right, what is the price change during the previous day? 24/32. Okay? So take 24 divided by 32, multiply that by 1,000, and you get how much the bond. This bond went up in price, which means interest rates went down. And here is the ask yield. This is the market rate, the IY. This is the rate that is used to discount the cash flows, the coupon payments, plus the $1,000 principal. Okay? So for this bond, 45 is the payment, 1338.75 is how much you'd have to pay for the bond. That's the current market price. 1,000 is what you would get in the future. 32.9 is the number of pay periods left. Compute IY, and you get 5.78%. This bond is trading at a big premium, 133% big premium, which means that the market rate of interest has gone down since the bond was issued. Okay? All right, now let's look at corporate bonds. Corporate bonds. Okay? They're very different. They're priced very different than treasury bonds. So, this is a typical quote on a corporate bond. All right? So, AT&T is the issuer. 7.5% is the coupon rate, and 2006 is the year of maturity. Okay? Now this bond is trading below 100, which means interest rates, the market rate of interest, is higher than the coupon rate. Okay? All right. So this is the current yield, and the current yield is the coupon payment divided by the market price. So it's 0.075 divided by 97.63. Okay, there it is. There's the current yield. This is the number of $1,000 bonds that traded, 554 bonds of $1,000 face value here, traded the previous day. Okay, 554 of those. The price of the last trade in terms of percentage of par, this is 0.9763. 0.9763 times 1,000. So these bonds are priced at $976.30. That's how much these bonds are priced at. So it's a lot easier to price these than it is treasuries. And this is the price change from the previous close. It's a percentage of par, so you would multiply this times 1,000. And you can see that the bond price went down, which means interest rates went up. And this bond is trading at a discount. Discount. So the bond went down slightly from the previous close. All right, let's look at interest rates. Interest rates are paid on loans and on fixed income securities, bonds, which is a form of loan. And an interest rate is the return a lender requires to entice the origination or the making of a loan. Okay? Or it is the rate of return that an investor requires in order to justify purchasing a bond. Lenders and bondholders expect to be compensated for the inconvenience and time of tying up their capital, for inflation, because you're going to get paid back in the future, and if you have inflation, that means the money you receive in the future, what isn't worth, it won't buy as much as that same amount would buy today. Therefore, your rate of return has got to pay you for your time and inconvenience and for inflation. And then lastly, you have to get paid for the risk you're taking that you won't get your interest or your principal back. Okay, so that's what's captured or incorporated into an interest rate. All right, so interest rates are commonly plotted on a graph called the yield curve. The yield curve. So the yield curve graphically illustrates the relationship between yield to maturity, the market rate on a bond, okay, and different maturities. So on the x-axis you have the years to maturity, when the bond will mature, and on the y-axis you have the yield to maturity, what bonds have to pay. And you can do yield curves for different kinds of bonds, treasury bonds, municipal bonds, corporate bonds, okay? The key is to do a yield curve for the same type of bonds. So one yield curve for treasuries, one yield curve for agencies, one yield curve for state bonds, one yield curve for AAA rated corporate bonds, another yield curve for AA rated corporate bonds, those kinds of things. Okay? The only thing that varies is maturity. Okay? So the shape of the yield curve, and I'm going to show you the two shapes, is a function of and a reflection of the economy. Economic growth. Is it strong, weak, high, or low? Okay? Monetary policy. What is the Federal Reserve doing? Inflation. Is inflation high or low? And then lastly, with corporate bonds, the yield curve, will reflect credit risk. What is credit risk? The possibility that the borrower will not pay interest or principal back. All right, so there are two primary yield curve shapes. Here they are. The first one, the most common type of yield curve, has a positive slope. It slopes upward. And what that means is the yield on short-term securities, this is years to maturity, 1, 3, 5, and then it goes 10, 20, 30. And the yields on these bonds, on short-term bonds, are lower than the yields on long-term bonds. And this is typical, I would say 90% of the time you have a positive yield curve. Now the slope changes over time. The slope changes. It may get steeper or it may get flatter, depending on economic growth, depending on demand for bonds, depending on inflation, depending on credit risk. This slope can go up or flatten out, okay? And so this positive slope reflects solid economic growth, moderate inflation, and moderate interest rate risk, okay? That's what's incorporated into this positive slope, these things. Good economic growth, moderate inflation, and moderate interest rate risk. Now let's look at the other type of yield curve shape, and this is called an inverted or negative yield curve, okay? So an inverted yield curve has a negative slope. Short-term rates are higher than long-term rates, okay? Why? Because the yields on short-term securities are higher than on long-term securities, and this happens when the Federal Reserve is tightening the money supply. They're taking money out of the system. They're selling bonds, and they're pulling cash out of the money supply in order to raise short-term interest rates. They want to raise rates. Guess what's happening right now? The Federal Reserve a year ago started raising rates. Back in 2009 when we hit the financial crisis, the Federal Reserve was buying bonds from banks, and they were flooding cash into the market. They wanted interest rates to be low, and they wanted the banks to have lots of cash. So they injected money into the system, which they hoped would be loaned out at a low interest rate in order to keep the economy going. Well, now they're doing the opposite. Now they're pulling money out. What does too much money in the system do? It causes inflation. And so the Fed is trying to pull some of that money back. So why is the Fed doing this? To slow the economy in order to keep inflation in check. You're a business student, and you need to know this. All right, in turn, investors will anticipate a decline in inflation over time, and so the inflation premium, the inflation component of interest rates, will get taken out. And also they expect GDP growth to slow down, which means demands for bonds will slow down, demands for money will slow down, and interest rates will come down. And that's why interest rates over the longer term are low. So yields on longer term securities decline. And what's really important about this is that virtually every economic recession in the United States has been preceded by an inverted yield curve. So you study the yield curve. If it's negative, that means the Federal Reserve is in there tightening, and there's a strong likelihood that we could go into a recession. We know that the economy will more than likely slow down. The question is, will it become negative, which would be a recession? All right, so we are finished. There it is, the end. We are finished with Chapter 7, Bonds. And we'll move on to Chapter 8, which is Stocks. Until next time, Dr. E says shalom.